Welcome to the CIO Chair, a podcast hosted by the CIO Investment Club in collaboration with the Pension Insurance Corporation. In each episode, we will sit down with top chief investment officers to explore their unique investment philosophies, decision-making processes, leadership strategies, and personal career journeys. Now let's get started. Welcome everyone to the CIO Chair, hosted by me, Sean Thompson.
And me, Hartaj Singh.
The CIO Chair's guest today is Veronica Humble, the Chief Investment Officer at Cushon, now part of WTW. Veronica leads the investment function and is a strategist for Cushon Master Trust. Prior to this role, Veronica was head of DC investments at Legal & General Investment Management. During her time at Elgin, she was responsible for investments, product development, and ESG initiatives within the DC business. Veronica started her career as a quant analyst in Phoenix Group and has a Master of Science in Mathematics and a PhD in Statistics. Welcome to the CIO Chair, Veronica. It is a pleasure to have you here. And as I always say to our guests, I hope you are sitting comfortably.
Thank you, Sean. Absolutely lovely to be here.
Fantastic. So first of all, warm welcome, Veronica. And if you could let us know, was finance always the plan?
Actually, no, not at all. I was a theoretical mathematician to start with, so I fell into finance somehow accidentally, looking for jobs after my PhD, having no idea that finance existed, but very quickly figuring out that actually that's quite interesting. So quite logically, I started as a quant, and then the rest gradually developed. And I remember exactly when I started doing DC pensions, which was really quite interesting. That was on the day when George Osborne announced that nobody needs to buy annuities anymore, almost the old pension liberation day. And a colleague who was in our wider team and solutions team at Elgin, who was hired to build out the DC business, was slightly overwhelmed with all the questions that she was getting. And I volunteered to help, and one thing led to another. So here I am.
That's brilliant. So were there any moves along the way to your role as CIO that felt risky or uncertain at the time?
Yeah, actually quite a few. So I went to work after I started as an asset liabilities quant in what is now part of Standard Life. I went to work for a small systematic hedge fund, which was really good fun. It was only for a year. It was quite small, but just being very close to the market, seeing how the strategies are performing like in real time rather than super long term at 20, 40-year horizon, hopefully, that I live in now. It was quite interesting. And then actually joining Cushon was really interesting as well, because I came from much more established institutional space to a challenge fund manager, not quite fund manager, pension provider, but it was really interesting. But I really liked where it was sitting, and if a challenger provides with a fintech firm with a really dynamic culture and kind of everything to play for and a big organization to back it. So it was still fairly risky, but I really like that type of risk.
Absolutely. So the defined contribution area, where you are obviously one of the key CIOs, is an exciting and growing area. What is the DC area and why is it experiencing such growth?
Yeah, DC is great. So we all are used to insurance or DB pensions in the past. However, DB pensions have been in decline for quite a while, not by assets, because that's been fairly stable, if not growing in the past, but from auto-enrollment that government has announced in 2012, that basically made it mandatory for all the employers to provide pensions to their employees. That sparked the growth in defined contribution pensions, where you just have investment. DB pensions, just to recap for our listeners, DB pensions is when you have specific promises that you have for your employees in the future, and you just deliver a fixed amount or kind of inflation-linked amount linked to their salary in the future. Whereas DC, there is no such thing. So you're just investing on behalf of employees or members of the pension scheme. And then when they come to retirement, it's their choice how to use it. So it's been growing from 2012 when the auto enrollment started, starting from very large schemes and down to micro employers. So now most of the people in the UK are enrolled in DC contribution pensions. And yeah, we're still growing. Our contributions are very quite strong and cash flows are very positive. So for the next 10, 15 years, DC will be experiencing still quite explosive growth.
That's amazing. And so people in their 20s are effectively saving for their retirement. And that's obviously a nudge into a saving. Like, what other behavioral nudges are inherent in the system?
I think the most interesting one is that most of the people are invested through the default funds, because we know that people in the 20s don't really think about their pensions. It's far away. It's not that interesting for them. To be honest, they have more pressing things than to really think about their retirement in 40 years' time. So what the industry was shaped to do is to make sure what they're invested in is appropriate and a good investment for them. So this is where the idea of a default fund came from. It's all steeped in in behavioral finance and works around that. So what happens if members are enrolled in their pension, they're automatically put into a fund or default strategy. They are totally allowed to opt out of that and choose investments themselves, but more than 90% never do. So this is why default funds are so important.
So how many actual members do you have within Cushon?
So we have over 700,000 members.
So 700,000 members, all of whom are very different in their stages of their life. And therefore, some may be young, some may be middle age, some may be close to retirement. How do they change their default fund as they grow older? Is that something that's done?
Yes, it's done for them. So as a lot of other providers, we have what is called in UKDC lifestyling. So you start with a combination of funds, and then a few years before retirement date or kind of nominated retirement date, that mix of funds start to change, and then you end up with a different mix at retirement. So it is higher growth first, and then slightly less volatile towards retirement. So typically very high equity allocation to start with, and then more bonds and cash heavy at retirement. So we follow the same pattern. Our de-risking period is 7 years. So we start with 75% in global equities, 10% in bonds, and 15% in multi-asset private markets in our headline strategy, and then go to low at about 50% in equities and the mix of bonds, again, private assets and inflation-linked bonds, etc., at retirement. But again, individuals are free to choose slightly different strategies. For example, if they want to target annuities, there is an annuity-focused strategy for them so that it moves much more in line with annuity prices, and there isn't a gap when they want to buy an annuity at a certain age. And then if they want to target cash as another outcome, again, there is one for them to choose from. But we have way more than 90%, sort of high 90s, that are in the main default fund.
I'm always surprised that it is that high, the number, 95%, let's say, in the default fund. Is that a surprise, or is that actually what one would expect you should be seeing across the industry and across DC members?
I think nobody was surprised that it will be quite high when this whole thing was designed earlier on. But I think people are still surprised that it is that high. It differs between different types of schemes. So in auto enrollment master trust, it's typically, yes, 95 to 99% are in default funds. In some of the industry schemes, so for example, in large banks, it can be much lower because people are more investment savvy or just investment focused and at different stages of life. So they might be choosing more actively.
That's great. And so, what is a master trust, and how do master trusts differ between each other?
So Master Trust is a multi-employer pension scheme. So typically before the auto-enrollment was set up, you would have pension schemes attached to the employers and to their DB scheme. DC might be a section of the DB scheme. And then it would all have different investment strategies. You would work with the pension provider to align your investment strategy or your scheme investment strategy to your beliefs or some such. When it was set up, the master trusts were allowed as these structures where different employers can come in and all have the same investment strategy, or maybe two or three types of investment strategies. So this is how it came to be. For example, we have 20,000 employers within our Cushon Master Trust now. So it's over 700,000 members, but also a large number of particularly small and medium employers, so that they don't need to analyze different different providers. They just choose the master trust option between different providers, and then everything is done for them in one go.
And who governs the master trust and who helps guide the decisions that are being made?
We have a set of trustees. They are the asset owners. They work closely with the investment team and with their investment advisors. There is this wonderful, delicate dance between all of us because, yes, we're an in-house investment team, but we then make proposals to the trustees. But then the investment consultants will make their recommendations off the back of these proposals and conversations with trustees. And then the trustees are the actual decision makers who make those decisions.
So are consultants still very much a big player in the DC world as they were and have been in the DB sector?
There are two types of consultants. There are investment consultants who will, as the name suggests, consult on the investment side, and they might be advising single trust schemes, they might be advising master trusts, and then there are more holistic employer benefits consultants who will then consult on a wider selection of employer benefits, and they also might be running the master trust selection processes if the single trust decides to go into one of the master trusts. So yes, in short, they're very much big part of what's happening, both in terms of advising the master trusts and rating the master trust and selecting them for the new employers, because we still have quite a few single employer trusts and we still have quite a few going into master trust in the next few years.
That's amazing. So, within that, what's the role of a CIO, and what does success look like for you?
Good question. Usually I discuss this with my managers. It's a good one. I think to me, this is still, we still drive the investment strategy. Yes, trustees are the ultimate decision makers, and we absolutely have very strong relationship and very good conversations with them along the way. There are normally no surprises because if you come with something, then trustees are deeply surprised by your suggestion. You've done something deeply wrong. So we get their feedback and their ideas around where they see opportunities and risks. We go and explore the market. We come with our proposals as well in terms of where we see the opportunities and risks. So this is kind of a very live and very sort of two-way, if not three-way, with consultants conversation. So we shape investment strategy, but we are not ultimately, from the regulatory point, responsible for that. We also, in our case, we actually have a great relationship with trustees where they push back, they challenge us. So we know that this is not a box-ticking exercise at all. It's quite challenging at times, but that's part of the fun. If you're not being pushed, if you're not being asked the tough exam questions, then it gets a bit boring.
Absolutely.
Yeah, so from my perspective, to answer the second half of your question, what success looks like is fundamentally we need to deliver good outcomes for our members. And that's what we work towards.
That's brilliant. And so you mentioned the asset allocation, which I think was 75% equities, 10% in fixed income, and 15% in private markets. How was that sort of modeled? What were the inputs to that sort of outcome?
So all sorts of modeling techniques here obviously, from very straightforward, let's just have some long-term premium assumptions for different asset classes with volatilities and correlations between them, to let's do some Monte Carlo modeling on top of that, so stochastic modeling, and look at the tail scenarios, to actually let's look at different risk scenarios as well. They can be stochastic, they can be just fixed scenarios, some in the past, some in the future. So I think you use all of the toolkit to make sure your allocation is robust and sensible. You can't really optimize it perfectly because there is a lot of uncertainty in the market. All your assumptions are fundamentally uncertain. So you're not trying to do the kind of optimal, incredible allocation for a very specific, narrow set of assumptions, but you need to make sure that with different approaches and with different models, it all still makes sense. And we have been, for example, building out the risk framework for that over the last year. So to make sure that, again, on different risk scenarios, we're still comfortable with our allocation. But there are some big questions there. Fundamentally, what's your risk assumptions for equities and equity risk premium, for global equities, for regional equities? What is the right level of risk for individuals at different life stages? And again, there isn't one perfect answer, but you need to have your set of beliefs, and you need to have trustees' set of beliefs. We're actually going through exercise with trustees at the moment to explore and reconfirm kind of some basic investment beliefs, and then you back solve it from there.
When you're looking at these modeling techniques, are there times when the answers might not be what you expected, and therefore your beliefs override the expected or the results of the modeling?
Given that we have a very long-term strategic asset allocation, normally it's not the case, because it just need to make sense from pretty much every angle. But at the same time, yes, we will look at the biases. We're currently actually looking at different style biases and need to ask ourselves, are we comfortable that we have this bias or that bias? Or do we want to be like neutral on every one of them?
And are people more concerned about inflation? And how does inflation figure into the thought process around long-term allocations?
Great question. So our trustees has set up a long-term comparator with CPI +3 for our overall strategy, which is quite interesting because obviously you can't quite deliver to that. It's not like you have an absolute return target and you can specifically deliver to that, or you can hedge this as with this DB approach. So it makes sense from long-term perspective, if they look at what members want and what members would think is a good outcome over like multiple decades. And then we need to make sure that we think this is sensible from the point of view of our asset allocation. That informs the risk levels, that informs also our approach to private markets, and this is why we have a fairly high allocation, and we can see that growing, for example, in the future potentially. So from the members' point of view, I think, look, I think inflation became more prominent 5 years ago, obviously, and 10 years ago when we had a very low inflation scenarios and low inflation environment, it was not quite the case. But I think now with first Ukraine and now Trump and Iran, we do have people worrying about that. We don't typically have members reaching out and being super worried, but we know that this is in front of people's minds.
And when you implement these, do you tend to manage assets in-house or do you use external partners?
We use a combination, so we don't use kind of direct investing in-house. So we obviously use partners and fund managers, but we use a combined approach. So, for example, for our private markets portfolio, we're working with Schroders, and we actually seeded the UK's first LTAF that we kind of co-created with Schroders. So this is a multi-asset private market portfolio that we then rely on then to allocate more dynamically to different asset classes. And for the time being, we will not have expertise in-house to do that. So maybe when we're at 100 billion, maybe even at 50, we will. For the time being, not quite. And it's not our strength at the moment. So we will outsource different parts of the management to different fund managers. It can be specific mandates on equities, for example. It can be satellite allocation for the private markets one, or it can be just, private markets SAA, for example.
And how does the LTAF work and what kind of assets does the investor get access to?
LTAF is basically a regulatory framework. It's a fund type that was made possible quite recently. And we actually think this was incredibly positive development for the industry because there was a lot of skepticism around private markets previously. And we went from, okay, this is all looking quite attractive, but how on earth do people actually in DC schemes can invest in that? Come LTAFs. And so now there is a solid framework to do that. And suddenly people are much more comfortable. So the conversations in the industry and with trustees and with other participants have moved from kind of how can we do this to implementation and to potentially actually going beyond LTAF and doing specific investments outside. But actually, so within the LTAF that we have, it's basically fund of funds with a fund wrapper on top and different requirements for liquidity and for valuations. We have, I don't quite remember how many sort of underlying funds we have, but quite a few. And then the manager of the LTAF can allocate more dynamically to the underlying strategies there.
And is the LTAF that's been run for you by Schroders, is it just you in the LTAF, or are there other asset owners investing in it?
There are other asset owners, yes.
And how does that work in practice, Veronica, in terms of, if other asset owners need to withdraw their monies, how does that affect the fund and your investment in it if you're continuing to stay invested whilst others might be coming in and going out?
So LTAFs have partial liquidity or kind of can have partial liquidity. And the fund that we have is exactly that. We actually just passed the 3-year mark when we can actually have liquidity out, not just liquidity in. So from our perspective, we don't need it. For us, it's important to be able to allocate new cash flows in. But there is a cap on how much can be withdrawn every quarter, and the fund is generally naturally designed so that it will get enough liquidity from the cash flow of the investments that they have inside the fund. From our perspective, we obviously welcome other investors as well, and yeah, we're happy to see it grow.
And how does responsible investing figure into your thinking when both in terms of investing via the LTAF, where you're giving the responsibility to another asset manager to allocate where they feel that they should allocate monies to, versus your actual asset managers that you've appointed that you have more direct input with in terms of what they can and cannot invest in?
Yes, responsible investing is extremely important to us, and particularly we were always very focused on climate. So actually, the Schroders fund that we're invested in on the private market side is called Climate Plus, Q in the name. But from our perspective, this is not just about purely portfolio decarbonization, that if you tilt your equity index and hooray, job done. This is an important tool, but what's becoming more and more visible now is that two other pillars of our responsible investing approach, which are the physical decarbonization and portfolio resilience, are becoming more and more important. And on the physical decarbonization, this is again part of our private market strategy. There is a lot of renewable infrastructure in there, and that's how we deliver the physical decarbonization and other things like very innovative agriculture. We have some very well designed low carbon greenhouses there, or kind of farms. I actually went and visited one of those, I think last year, possibly a year and a half ago, which was really good fun. And I've taken back some peppers from it that my children immediately chomped through. So they were eating their pension, literally. And on the other hand, I think what we're seeing now, the portfolio resilience becomes more and more important, particularly with recent events and with inflation shocks. And part of that is, again, renewable infrastructure that delivers long-term energy security, but at the same time, other elements like we have a mandate with Aviva investors, which is for natural capital, which we think, again, medium to long term will help that.
Do you see a lot of the responsible investing, is that coming from you as CIO at Cushon and your investment team and the trustees? But do you also see a lot of it coming from the members themselves wanting more responsible investing being invested in within their schemes?
I think it's both. I think there's definitely demand for the responsible investing in members and in employers. But at the same time, it has become now part of just standard investment process. If a few years ago, this was driven by the client demand, now you just need to take it into account. And we're actually working with one of the startup companies who are doing like really interesting data on physical risks and transition risk called TREX, Transition Exeter. So they are an offshoot from Exeter University, and they are looking at just completely different data for where we most interested, in addition to a slightly different way of looking at the transition risk, is the physical risk. So if you think about it, like same industry, almost very similar plants, but one located somewhere where there is a high risk of flooding and the other one somewhere where there is a much lower risk, will be affected differently. And this is no longer something on the like 2050 horizon. It is the heightened risks for wildfires and floods and other extreme weather events are being observed now, and particularly will be fairly visible over the next 5-10 years, which is already within our immediate investment horizon. So you have to take this into account when you look at your portfolio.
And in terms of getting the exposure from equities, I guess there are a couple of questions that seem to come up with equity allocations. Number one is the concentration in the US, particularly in the Mag 7, like large stocks. And the second one is currency risk, given that recently, let's say, dollar to sterling has been quite volatile.
Yeah, so both great questions. I'll start with the currency risk, actually. We were traditionally not hedging the currency risk. We are currently working on hedging that. There is a question, what's the process and at the levels, but we're just in the process of putting it in place, the mechanisms for that. And on concentration, again, great question. But I think to me, this is about your core investment beliefs and kind of your processes. So we historically didn't have any caps on concentration there. So we are just in our equity portfolio, there are no country biases and no kind of caps on individual stocks exposure. Good question whether this should continue, but for the time being, that's aligned to our investment beliefs. So So this is where we are. And I think kind of people should be quite disciplined around where it's coming from for them. And I can see both, but it's also very easy to have slightly more knee-jerk reaction. Ooh, it's really concentrated, but do you really believe that how much of a risk it is? And we all had these conversations 2 years ago and it was seen as like a massive risk. At the same time, didn't really work out that way, and the Max 7 did ride the wave incredibly well.
That's great. And then in terms of the UK, obviously, presumably all of your savers are UK based.
Yes.
How does the UK figure in your portfolio, either through the bonds, equities, or your private assets?
Again, on the equity side, we have a global portfolio, so we don't have the UK bias. It's just proportionate to a part of the global economy. On the private side, there is a very different story, and I think more than half of our investments are in the UK. And of our renewable infrastructure is basically all of that is in the UK.
And are there investment opportunities that, if they were available in the UK, would increase the allocation to the UK? Or do you think where you've currently got it is where it's likely to be for the long term?
That's a good question. I think that will probably depend on the views of our fund managers, frankly, because I'm not structurally in a position to pick individual industries. We do have, and our fund managers do have better access to the UK opportunities if they are UK based. Again, with Schroders, they have a fairly significant bias to the UK within their portfolio, which works well for us. We have recently invested in British Business Bank's British Growth Partnership Fund 1. So that will also be primarily UK. And again, like that works well for us. And I think it makes perfect sense.
Well, congratulations on that. So, in terms of mistakes and lessons, how has your investment style evolved over the years or since you started in the investment landscape?
So I think from my perspective, it's about being just disciplined around risks and opportunities and having a proper processes and kind of people to worry and think about specific items rather than just trying to cover everything in terms of not quite mistakes, but much more where the focus is. So for GC, the level of risk is super important. And I think what we have seen is there were a lot of under risk strategies historically, and they were not adaptive enough to basically ride those 10 years of phenomenal equity growth. I do worry whether the world has shifted and now we're in a much more diversified, much riskier world. But again, to see the previous point about having the right investment processes and thinking around this rather than just initial worries.
Do you see what's going on around the world at this moment in time? Is there more uncertainty in terms of where the investment return and the opportunities are going to come from going forward versus perhaps looking back in 2008, global financial crisis? Where do you see today fitting in with perhaps the way you've managed and been a CIO at Cushon in the past?
I think today is, for me, it's again going back to what are the members' long-term objectives and remembering that we're delivering to those and not being distracted by short-term events because we're talking 10, 20, 30, 40-year horizon, which is quite frightening, but nonetheless. I do remember, though, on the financial crisis, I started a year before that, and we were actively discussing with my boss at that time when I was coding up the economic scenario generator whether the equity risk premium is zero or not. So it's quite funny to look back at that. And again, the phenomenal equities growth. And I think that it's about being disciplined and being plugged into the discussions, but at the same time, not forgetting the long-term nature of that investing. Nobody knows the answer. Is like American exceptionism there, or is it shifting? Maybe it's shifting a bit, but has something fundamentally changed? Are equities still the way to go or not quite? These are all very interesting conversations and very, very pertinent ones, but nobody knows the answer. So it's about being disciplined and thoughtful about what do you assume and why.
So you mentioned being disciplined. Sort of what leads to me to one of the next questions is, what do you think makes a great investment team, and what role does culture play in the decision making that team makes?
Great question, and I just absolutely love my team, and I think what works really well is that everyone has their areas of ownership that are aligned with what they're passionate about and what they know almost most about, but at the same time everyone overlaps a bit, so you don't have kind of key person risk, and people can be not quite interchangeable, of course, but people can step in. Everyone knows what others are doing broadly. And you have, for each topic, you will have kind of a couple of people who can cover that, but there will be a core ownership for each of the topic from one of the people. And I think if you can structure it that way, that then naturally works really well.
So following on from that, when you're looking to hire someone into the business, what often gets overlooked, and what is it that you might look at differently to someone else when they're looking at hiring someone within the investment team?
I think what often gets overlooked, people often might get quite regimental in terms of we need exactly this, whereas there might be people in the market who can cover this, but also something else. Or maybe you have people in the team who can step up. The way I approached this in the past was almost like, okay, here is the matrix, and here are the things where I would like more capabilities, and then see who's available or in particular time frames, and then you can flex different people doing different things. Sort of with my latest hire, actually, it was amazing because the person just fit the role incredibly well, but I didn't expect that to happen. I could see two different roles there, and it could have been two completely different people in that position, and then we would have flexed other people doing kind of other bits.
Do you think that people coming straight out of school and not going to university don't have a chance of getting themselves into the financial services sector? Do you think you have to be a graduate to be able to make it in the investment industry?
Very good question. It's difficult for me because I come from a quant
Yeah,
background,
yeah, yeah,
which is PhD heavy.
yeah,
But actually, I don't think it depends on how good your schooling is. Basic maths is super important and understands orders of magnitude, how things fit together. But I can see actually apprenticeship routes
yeah.
as well.
Because I never went to university. I went, obviously, they're a little bit older than others who might be coming into the industry, but I didn't go to university, and it didn't, fortunately, hold me back. But I just wonder whether or not that was a time back then and how different it may be today, and what people need to do to get themselves into the financial services industry if they do lack the graduate degree, etc.
I think there are quite a few apprenticeships around the industry, and that's probably the best route.
So technology, obviously, Cushon is a fintech firm. How is technology affecting the investments industry, either within the investment process or more generally?
So from our perspective, as you said, we're in fintech firm. This means that we built everything ourselves. So our founder basically started it as usual in his kind of shed or room, being frustrated about an inability to get the right ICE invest. So started playing with models and then built it from there. But we own all our tech, which is very exciting because the way it affects it is, for us, certain technical challenges are just not a consideration. You can have different priorities and like sequencing can be different, but the question is, oh, if we want to do this, does it mean that we have a 3-year development program and we need to go to external parties? It's all a bit too difficult. Is just not the way we think. Is it doable? Yes. Can we do it? Absolutely. What will it take us? And then we take it from there. And this is really good fun. This is actually what attracted me to Cushon in the first instance as well. In terms of kind of future tech developments, I think the whole industry is obviously undergoing changes and will be really interesting to see how it plays out. I think from the purely investment perspective on our time horizons, I don't quite see the immediate impact because it's about sort of members' priorities again over long term. And it's more about investing in tech companies rather than immediately optimizing something on the short term horizon. But obviously, the whole industry will get quite disrupted. And we see a lot of adoption of AI already. And we have stuff in house. We have already started doing quite a lot of things in house.
And I think you talked about AI is out there now, and we're starting to see whether it's going to have impact or not. What advice would you give to someone who's just about to start their career in finance? What are the traits that could help them stand out?
So one of the people in my team just learned to code in 3 months and coded up some of our reporting, internal reporting from zero.
That's amazing.
So
That is
yeah, that's
amazing.
amazing. Exactly. And I remember us discussing a few months, sometime last year, how we should go about this. Do we need to send him to courses or something? But no, just through AI systems and through just learning by doing. And I think learning by doing is something that our industry is really good at and people forget about as well sometimes. To Sean, to your previous question about kind of non-graduate routes, most of this stuff you will never be taught at uni at all.
Yeah.
Right. So, if anything, really, it's more kind of some fundamental maths or economics and some of the finance that can be helpful, but none of it is mandatory. So, there is a lot that you can learn just on the job. I started as a theoretical mathematician, and it was fascinating because even from purely maths perspective, when I started coding up those economic scenario generators, like finally you got the feel for how the models behaved, because theoretically I can derive all that, I knew that, but I never had the sense. It was really interesting, and I think it's more and more of this will happen now with acceleration of tech developments, that people just can get the knowledge straight away. You need to be very careful and don't get caught up by hallucinations and be much more critical, but it's a great enabler.
So just going back, the fact that you were a quant analyst, just interesting to know what's your view about quantitative and systematic investing, and how do you see that as playing a part in investment strategies, and do they play a part in yours?
Currently, no. I think, to be honest, this is a more short-term alternative investment. There is an argument whether you want, as a diversifier, to include some of the quant strategies. Some of that actually, mind you, already included or can be included in the equity indices design or kind of other indices design, but more on the medium to long-term horizon. But I think the question is, from the DC perspective, is also what's the cost efficiency and how much you're getting from this versus your time horizon. And I think DC was typically much more simpler indices and now potentially a bit more in private markets. But I think everything is on the table, but it's just where the priorities are.
So we're just coming towards the end, Veronica, and I was just wanting to find out from you, how do you stay informed about key trends in the field of finance in terms of the role that you play at Cushon? What do you look at? What do you read? What other podcasts do you listen to? What is out there that interests you most, that you might want to say to others that they should think about reading and listening to?
So to me, the industry has a lot of conferences, events, webinars that are super interesting and super important. I think kind of in terms of reading and books are probably lagging quite a bit. They're interesting, but they are more for general interest. In terms of what's happening right now, podcasts are good for kind of for chats and for understanding where people's priorities are, understanding the market, where your competitors are. But I think for me, the primary one is probably conferences and industry events.
Smaller, engaging investment breakfasts and lunches that the CIO investment.
Exactly.
Oh, there we go.
Exactly.
There we go.
Shameless. And one before we go to the sort of the quick fire round, what would you want your legacy as a CIO to be?
Fundamentally delivering for our members and them being both comfortable in terms of where their finances are versus their trajectory for retirement, but also demonstrating to them what their money is invested in. And that was always a big part of Cushon. It's not just purely investment side, but it's also using our tools and kind of us being a fintech and our app and the way we deliver content to our members to actually demonstrate what we're doing. We have a map of the UK, for example, with all the dots around where the investments are. And again, now investing in the VC fund, just being able to show this is what we're doing with your money so that you feel a bit better around your money being locked in for 40 years.
Brilliant. Thank you.
Fantastic.
It's been an absolute pleasure. But before we go, we have our quick fire round. You may have heard of it. You may have even listened to it. So we're going to ask you your favorite things. So you've got to be quick off the mark. Favorite sport?
But tennis?
Tennis. Do you play?
Nope.
Okay, but just enjoy it. Excellent.
Yes.
Favorite film or TV drama?
So the film that I probably watched the most was Amelie, and I think I love the soundtrack. But I think these days it's quite difficult for me to go to cinema. But I used to do a lot of that, and I love the 1920s German expression cinema and things like that.
Brilliant. Favorite drink?
Ooh, that will be probably a Negroni.
Oh, very good.
I don't have a favorite book because I read more books and there is always more information. I rarely reread things, but yeah, I
You like
can say what I'm
books?
reading. So it's mostly work and work related or children and children related. But at the moment, I'm reading Chip War, which I should have read a couple of years ago, but
Very
nonetheless,
good. Okay. And lastly, favorite hobby?
I don't have a hobby. I have children
Yeah,
and work.
okay. That is your hobby, children. There you
Yeah.
go. Easy. Easy peasy. Listen, Veronica, it's been an absolute pleasure. Thank you so much for joining us on the CIO Chair. We look forward to perhaps talking to you again sometime soon.
Thank you very much. It's been an absolute pleasure.